Breaking news just hit the auto industry, and it is sending shockwaves from Detroit to dealership lots across the country, because General Motors has just made a move so aggressive, so unexpected, that analysts are calling it a full-scale price war declaration, and the consequences could permanently reshape how much Americans pay for cars. GM didn't hint at this, didn't tease it, and didn't ease into it. They slammed the button, and prices started falling fast. Here's what makes this so explosive. GM has begun slashing prices across multiple segments at the same time. Not just one model, not just one brand, but a coordinated drop that affects sedans, SUVs, trucks, and even electric vehicles. This isn't a seasonal discount or a quiet dealer incentive. This is GM stepping in directly and saying the old pricing structure is done, and if competitors don't respond, they risk losing buyers overnight. Dealers are already feeling the pressure. Vehicles that were sitting on lots with premium price tags suddenly look overpriced compared to GM's new numbers. Buyers who walked away weeks ago are now coming back, shocked at how much cheaper the same vehicles suddenly are. Some price cuts are so steep that people who bought recently are questioning how fast the market is moving and whether the era of inflated car prices is finally cracking. But the real bombshell is what this signals behind the scenes. GM isn't doing this because things are calm. They're doing it because inventory is stacking up, consumer demand is shifting, and high interest rates have pushed buyers to the edge. Instead of waiting it out, GM chose to strike first, forcing the entire industry into a corner where cutting prices may be the only way to survive. Electric vehicles are where this gets even more intense. GM's EV pricing moves are putting direct pressure on rivals who were already struggling to justify high sticker prices. When a legacy automaker like GM starts undercutting expectations, it sends a message that EVs can't rely on hype anymore. They have to compete on real-world affordability, and that changes everything for manufacturers who built their strategies around premium margins. What's happening right now looks less like a sale and more like a reset. Consumers are suddenly holding the power again. Negotiations are shifting. Dealers are calling corporate offices. Competitors are watching closely, because if GM's gamble works, the next wave of price drops could spread across the entire market, dragging down prices that once seemed locked in for years. And the most unsettling part is that this may only be the opening move, because once a giant like GM pulls the pin on pricing, there's no easy way for the rest of the industry to put it back, and the ripple effects are just beginning to surface as buyers, dealers, and rival automakers scramble to react in real time behind closed doors. Executives across the auto industry are now recalculating everything, because GM's price drop doesn't just affect today's sales, it threatens future profit models that were built on the assumption that high prices were the new normal. That assumption is now cracking, and once it breaks, it is almost impossible to rebuild. Automakers that followed GM upward during the price surge may be forced to follow them back down, whether they can afford it or not. This move also exposes a deeper problem that many brands have been trying to hide. The average buyer is stretched thin, monthly payments are hitting record levels, and patience has run out. GM clearly sees that consumers are no longer willing to play the waiting game or accept inflated pricing. By cutting prices now, GM positions itself as the brand that listened first, while others risk being labeled as greedy or out of touch. The shock is already spreading beyond new cars. Used vehicle values are starting to feel the pressure, because when new cars suddenly become more affordable, the inflated used market loses its advantage. This could trigger a chain reaction where trade-in values fall, loan balances tighten, and lenders start adjusting risk models almost overnight. The entire ecosystem around car buying is being shaken, not just the showroom floor. What makes this moment so dangerous for competitors is the timing. Many manufacturers are locked into high-cost production cycles, expensive technology rollouts, and long-term supply contracts. GM's scale gives it room to maneuver, while smaller or more leveraged brands may have no choice but to absorb losses just to stay relevant. That imbalance could decide winners and losers faster than anyone expected. And as this unfolds, consumers are watching closely, because once buyers realize that prices can fall this fast, the psychology of the market changes completely. Hesitation turns into leverage, urgency flips sides, and the industry finds itself facing a new reality where control is slipping away and the next move could determine who survives and who doesn't. The silence from some automakers right now is almost as loud as GM's announcement, because every hour without a response makes their pricing look weaker and more fragile. Buyers are comparing numbers, sharing screenshots, and asking dealers uncomfortable questions that didn't exist a month ago. When transparency hits this hard, it becomes impossible to maintain the illusion that prices are fixed or justified by supply issues that no longer feel real. Dealerships are caught in the middle of this storm. Many stocked inventory at higher costs, expecting prices to hold, and now they are staring at shrinking margins and difficult decisions. Do they match GM and move volume, or hold firm and risk watching buyers walk across the street? That tension is spreading fast, and the longer it lasts, the more pressure builds on the entire retail side of the industry. This is also rewriting how buyers think about timing. For years, people were told to buy now or pay more later, but GM just flipped that narrative on its head. Now the message is clear that waiting might actually pay off, and that idea alone can slow sales across the market. Even brands that haven't cut prices yet are feeling the hesitation as consumers pause, expecting the next announcement to drop. What's especially revealing is how quickly confidence is shifting. Analysts who once defended high prices as sustainable are now quietly adjusting forecasts. When the biggest players move first, it forces a reality check that spreadsheets alone can't ignore. The belief that demand would absorb any price is being tested, and the results are not reassuring. And beneath all of this, there's a growing sense that this isn't just about GM winning market share, but about correcting a market that drifted too far from what buyers could realistically afford, a correction that may still have much further to go. The speed of this shift is what has industry veterans genuinely uneasy, because price corrections like this usually happen slowly, quietly, and in isolated segments. What GM has done is fast, public, and impossible to ignore. When a market leader moves this decisively, it removes the safety net that others were counting on, and it accelerates changes that were already building beneath the surface. There is also a strategic angle that many people are missing. By lowering prices now, GM is forcing competitors to choose between protecting margins or protecting relevance. Both are expensive choices, and neither is guaranteed to work. Brands that hesitate risk losing loyal customers, while brands that react too quickly could burn through cash at a dangerous pace. For consumers, the implications go far beyond a single purchase. Leasing terms, financing offers, and even insurance valuations are tied to vehicle prices, and when those prices drop, everything connected to them starts to move. This could quietly lower the total cost of ownership over time, but it also introduces uncertainty that lenders and insurers are not comfortable with. What's unfolding feels less like a temporary adjustment and more like the early stages of a structural change. The industry spent years pushing prices upward, normalizing bigger payments and longer loans. GM's move suggests that ceiling has finally been hit, and now the pressure is coming from the other direction, hard and fast. And as this pressure builds, the question everyone is asking is not whether prices will continue to fall, but how far this domino effect will travel once more manufacturers are forced to make their move and the balance of power keeps shifting away from the sellers. The real danger zone now is for brands that built their entire identity around premium pricing without the loyalty or volume to support it. When GM lowers the floor, it exposes which manufacturers were relying on market conditions rather than genuine demand. Buyers begin to ask tougher questions about value, reliability, and long-term costs, and flashy branding alone stops being enough. At the same time, suppliers and parts manufacturers are watching this closely, because lower vehicle prices often translate into tighter budgets across the supply chain. Cost-cutting pressure doesn't stop at the automaker level. It travels downstream, affecting everything from component pricing to factory staffing, and that ripple can reshape entire regions dependent on auto manufacturing. This moment also puts labor contracts under a microscope. Wage agreements, production targets, and plant investments were negotiated during a period of high pricing and strong margins. If those margins shrink faster than expected, automakers may be forced back to the table, creating tension that extends well beyond showrooms and into communities that rely on stable auto jobs. Meanwhile, consumer expectations are being permanently reset. Once buyers see meaningful price drops from a major player like GM, they remember it. Future price increases become harder to justify, and trust becomes more fragile. The industry may find that even when conditions improve, consumers will resist returning returning to the old pricing playbook. And as this reset continues to unfold, the market is entering a phase where every announcement, every incentive change, and every quarterly report will be scrutinized for signs of who can withstand this pressure and who is already cracking under the weight of a pricing war that shows no signs of slowing. What makes this moment even more volatile is the global context surrounding it. International automakers are already dealing with currency swings, regional slowdowns, and uneven demand across markets. GM's aggressive pricing move in the US adds another layer of stress because global brands now have to decide whether to mirror these cuts worldwide or risk losing ground in one of their most important markets. There is also a psychological shift happening inside dealerships and boardrooms alike. When confidence breaks, decisions become reactive instead of strategic. Incentives get rushed out, marketing messages change overnight, and long-term plans start to unravel. GM's move may have injected urgency into an industry that was already walking a tightrope, and urgency often leads to mistakes. Investors are paying close attention as well. Stock valuations, future earnings projections, and capital investment plans are all tied to pricing power. If GM proves that volume at lower prices can outperform high margins with slow sales, it could force a complete reevaluation of what success looks like in the auto sector. That kind of shift does not happen quietly or without resistance. For buyers on the sidelines, this is creating a strange mix of excitement and caution. The deals look better, but the uncertainty is growing. People are asking whether prices will fall further, whether new incentives are coming, and whether waiting just a little longer could save thousands more. That hesitation alone can amplify the slowdown, pushing automakers into even more aggressive moves. And with every passing week, the industry drifts further from the stability it once relied on, moving into a landscape where price leadership matters more than brand promises, and the next decision could accelerate the market into territory no one fully controls. One of the most overlooked consequences of this price plunge is how it could reshape product planning for years to come. When prices fall, automakers are forced to rethink which vehicles make sense to build at all. Models that were barely profitable under higher pricing may suddenly look unsustainable, leading to quiet cancellations, delayed launches, or abrupt shifts in focus towards safer, higher volume segments. This also raises serious questions about technology investments. Advanced features, large infotainment systems, autonomous driving development, and electrification all come with massive costs. If pricing power weakens, companies may be forced to slow innovation or cut features that consumers were told were the future. GM's move may end up deciding which technologies advance quickly and which ones get pushed to the sidelines. The competitive pressure is now bleeding into marketing narratives. For years, automakers justified rising prices by emphasizing scarcity, innovation, and premium experiences. That story becomes harder to sell when a major manufacturer publicly signals that affordability matters more than exclusivity. Buyers start to see through the messaging, and once that happens, regaining trust is incredibly difficult. There is also a regional impact unfolding. Areas that depend heavily on auto sales, logistics, and manufacturing could see sudden swings in activity. Increased sales volume may help some regions, while margin compression could hurt others. The uneven effects make this situation even harder to manage, because no single response will work for everyone involved. And as these layers stack on top of each other, the industry finds itself deeper into a transformation that began quietly but is now accelerating fast, driven by a single pricing decision that continues to echo through every corner of the market. Another pressure point now emerging is how this impacts long-term brand loyalty. When prices swing this dramatically, some consumers feel rewarded for waiting, while others feel punished for buying early. That emotional response matters because it can permanently alter how buyers relate to a brand. GM's challenge will be managing that perception while competitors struggle with the same issue, often without the scale or flexibility to soften the blow. Fleet buyers and corporate customers are also recalculating. Large orders are negotiated months in advance, and sudden market-wide price drops can force renegotiations or delays. If GM becomes the benchmark for aggressive pricing, fleet contracts across the industry could reset lower, compressing margins even further and locking in reduced profitability for years. This situation is also colliding with government policy and regulatory pressures. Emissions targets, safety requirements, and EV mandates all require heavy investment. investment. When prices fall, funding those obligations becomes harder, especially for companies already stretched thin. GM's move may unintentionally expose which manufacturers were relying on strong pricing to meet future compliance costs. Consumer behavior online is amplifying everything. Price drops spread instantly through social media, forums, and group chats, accelerating awareness far faster than traditional advertising ever could. That speed removes the ability for companies to control the narrative, turning pricing into a public real-time scoreboard that everyone can see. And with that visibility, the margin for error disappears, because every adjustment is scrutinized, every delay is questioned, and every response or lack of response adds to the growing sense that the auto industry has entered a phase where stability is no longer guaranteed, and the next shift could be even more dramatic. As this pressure builds, even the financing side of the industry is being pulled into the turbulence. Banks and lenders base their models on predictable depreciation curves, and sudden price drops disrupt those assumptions. When vehicle values fall faster than expected, loan terms tighten, approval thresholds shift, and buyers who once qualified easily may face new hurdles, adding another layer of instability to the market. Insurance providers are watching closely as well. Vehicle replacement costs, repair estimates, and total loss calculations all depend on market values. A rapid adjustment in pricing forces insurers to recalibrate risk, which can lead to unexpected changes in premiums and coverage terms. These secondary effects often hit consumers quietly, but they can be just as impactful as the price drop itself. Inside GM, this decision likely reflects confidence that volume can offset margin compression. By moving first, GM positions itself to capture buyers who were priced out or waiting on the sidelines. If that strategy succeeds, it could validate a new playbook focused on scale and speed rather than maximum per unit profit, forcing the rest of the industry to reconsider its priorities. At the same time, this move places immense execution pressure on GM. Lower prices only work if production, logistics, and dealer networks operate with near-perfect efficiency. Any disruption could turn an aggressive strategy into a costly mistake, and competitors will be watching closely for any sign of weakness. And as the market digests these changes, the line between bold leadership and risky overreach becomes thinner by the day, with the outcome hinging on how quickly demand responds and how aggressively others are willing to follow GM down this path. There is also a broader economic signal embedded in this move that cannot be ignored. Automakers typically resist large price cuts unless they see sustained pressure ahead. GM's willingness to act this decisively suggests internal forecasts that may be far more cautious than public optimism would imply. When a company of this size prepares for leaner conditions, it often means the warning signs are already flashing. Consumer confidence is a critical variable here. Big-ticket purchases like vehicles are often delayed when households feel uncertain about the future. GM's pricing shift could be an attempt to unlock demand before that hesitation deepens. If successful, it may stabilize sales temporarily, but if confidence continues to erode, even aggressive pricing may not be enough to reverse the trend. This dynamic also changes how incentives are perceived. Rebates and discounts were once seen as limited time opportunities. Now they risk becoming expected. When expectations shift, it becomes harder for manufacturers to pull incentives back without triggering backlash or demand slowdowns, trapping the industry in a cycle of perpetual discounting. For competitors, the strategic window is narrowing fast. Waiting too long could make their inventory look uncompetitive, but moving too quickly could damage brand positioning and long-term profitability. Every day of delay increases the cost of response, yet every response carries risk. And as these pressures converge, the auto industry edges closer to a turning point where decisions made in this moment will define pricing norms, consumer behavior, and competitive balance for years to come, with no clear path back to the stability that once defined the market. Meanwhile, the ripple effects are already touching resale markets, which traditionally act as a buffer in times of instability. As new GM vehicles drop in price, used car valuations may begin to adjust downward faster than expected. Buyers who counted on strong trade-in values could see the real cost of ownership shift dramatically, creating a feedback loop that pressures dealerships even further. Even beyond the US, international automakers are forced to reevaluate. Many had pegged pricing strategies to North American trends, and GM's bold cuts disrupt those assumptions. Global competitors must now consider whether to maintain their higher prices abroad or risk losing market share to parallel adjustments in international markets, effectively stretching this shockwave across continents. Electric vehicle adoption is another critical arena being reshaped. GM's aggressive pricing of EVs signals that affordability is finally the lever that will drive mainstream adoption. Competitors who had been relying on brand prestige, tax incentives, or exclusivity may now be forced to compete on price alone, accelerating a shift toward mass market accessibility faster than anyone projected. Meanwhile, corporate fleet strategies are recalibrating. Companies that purchase vehicles in bulk now face renegotiations and delayed acquisitions because what once seemed like a stable contract is suddenly vulnerable to market fluctuations. This has cascading effects on logistics planning, budgeting, and even employee compensation structures tied to company vehicle programs. And as all these factors collide, consumer psychology, dealer strategy, financing, insurance, global competition, and EV adoption, the industry finds itself in an unprecedented state of flux, where every decision is amplified, every delay is costly, and the next announcement from GM or any competitor could tilt the balance completely in one direction or another. What makes this period especially volatile is the speed at which perceptions are shifting. Buyers are no longer willing to accept yesterday's pricing logic, and social media ensures that every discount, every incentive, and every dealer negotiation spreads instantly. GM's move has effectively turned the market into a real-time scoreboard, where consumer sentiment reacts faster than traditional corporate strategy can keep up with. At the same time, automakers are confronting the hard reality of cost structures. Lowering prices isn't simply a matter of slashing numbers. It tests production efficiency, supply chain resilience, and workforce flexibility. Any misstep in execution could turn a bold pricing move into a costly operational headache, while competitors are watching closely, ready to capitalize on even minor stumbles. Dealerships are feeling the pressure more acutely than most. Many stocked inventory under the assumption of higher margins, and now they must balance moving vehicles quickly to stay competitive while protecting limited profits. That tension is forcing fast, sometimes reactive decisions, which could reshape local markets and even affect dealer loyalty toward manufacturers, depending on who supports them best through this transition.